Welcome back to The Explainer. Okay, today we are diving into a really fascinating paper out of the London School of Economics by James Simons Hicks. It's called From Learning to Earning. And we're going to be unpacking this massive, kind of mind-boggling behavioral paradox when it comes to how we build wealth. We're talking about those hidden mental roadblocks that are literally keeping us from maximizing our money. Let's get right into it.
So check out this absolutely startling figure. Only 22% of UK households actually hold stocks. Just pause and think about that for a second. We live in an era where information is literally everywhere, right? Investment apps are sitting right there in our pockets. But despite all that, nearly 80% of the population is just sitting completely on the sidelines when it comes to equity markets. And, this brings us to a huge behavioral paradox, and honestly, one that might actually mirror what's going on in your own bank account right now. Over the past decade or so, global equities have delivered average annual returns of around 9%. Meanwhile, UK cash deposit accounts, they've yielded roughly 0.9%. I mean, that is a staggering difference when you think about compounding wealth over a lifetime. Yet, people are overwhelmingly hoarding cash. They are systematically passing up those higher expected returns. Why?
Now, the really wild part of this data is that we're not just looking at a low-income problem here. When you break down households by their investable assets, even among relatively wealthy households, we're talking folks holding between £50,000 and £100,000, 35% keep absolutely everything in low-yield cash. And if you zoom out to the total population with over £10,000 in savings, 38% hold it all in cash. So they absolutely have the financial buffer to take on some risk, but they simply refuse to.
Well, for years, the classic economic explanation for this whole thing was what they call monetary participation costs. Basically, people blamed the barrier of high fixed entry fees or per-trade costs. And hey, that made sense, right? If you only have a little bit of money to invest, a £10 trading fee is going to completely eat your returns. But with modern platforms offering commission-free trading from literally just £1 since 2018, that old excuse is entirely gone. The financial barriers to entry have practically vanished, yet participation rates haven't skyrocketed to match. So what gives?
So here is the absolute crucial point. The real barrier keeping people out of the market isn't a lack of wealth at all. Actually, it's a lack of financial literacy acting as this massive mental roadblock. The research calls these financial literacy frictions. It's not the monetary cost of the trade anymore. It's the mental cost of figuring out what to trade. It's the sheer complexity of the market, the intimidation factor, the fear of making a massive mistake. This invisible, non-monetary friction is exactly what's keeping all that money parked in savings accounts, basically losing to inflation.
And when the researchers broke down stock participation by both the household's wealth and their standardized financial literacy score, the divide became incredibly obvious. For example, among households with high assets, over £50,000, if they answer 0 literacy questions correctly, their market participation is only 21%. But if they answer all the questions correctly, participation skyrockets to 56%. So wealth alone doesn't get you into the market. You absolutely need the financial literacy to lower that mental barrier to entry.
And it goes deeper. Highly literate households don't just participate more often, they actively and aggressively shrink the percentage of wealth that's just wasting away in cash. Take individuals with over £250,000 in investable assets. Even with £250,000 sitting there, those with the lowest literacy scores still hold roughly 70% of their portfolio in cash. But the folks with a perfect literacy score, they drop that cash holding way down to 45%. Basically, your literacy dictates how much risk you're actually comfortable taking on.
But this creates a massive catch-22, doesn't it? I mean, you might be sitting on some cash right now thinking you need to read 10 books, listen to 50 finance podcasts, and become an absolute Wall Street expert before you even start investing. You naturally want to clear that mental friction first. But, as the data reveals, that logic is actually completely backwards.
The paper introduces this highly empowering concept called learning by doing, and it proves that the very act of putting money into the market is exactly what creates your financial knowledge. Think about it. You don't get smart to invest, you invest to get smart. The hands-on experience of actually holding an asset, watching it fluctuate, making those small portfolio adjustments, that actually builds your financial literacy far more effectively than any theoretical study ever could.
And this learning by doing mechanism is just incredibly powerful across the board. The data shows some pretty substantial, distinct gaps in financial literacy when people have zero investments. For instance, men generally scoring higher than women and degree holders scoring higher than non-degree holders.
But here is the magic part. Just by putting more money into non-cash investments, those huge literacy gaps between genders and between education levels almost entirely vanish. The data lines literally converge. Actually, engaging with the market is the ultimate great equalizer.
Now, I know what you might be thinking. Well, maybe smart people just invest more, and that's why the lines converge, right? It's a totally fair point about correlation versus causation. So to prove it's actually the experience driving the knowledge, the researchers needed a random, natural experiment. And they found one: recent, unexpected inheritances. They discovered that randomly receiving an inheritance of stocks literally forces market entry, and it makes people measurably smarter about finance. Just moving from not owning stocks to owning them via an inheritance raises a person's expected financial literacy score by a massive 0.36 points. It completely, forcefully breaks down that mental friction we talked about.
This has some really huge implications, especially when we look at potential future policies. The paper models what happens when you give an equal-sized transfer to households, one in cash and one in stocks. Handing out cash, it barely changes a person's life trajectory. The data shows it has almost no long-term effect on market participation and is mostly just consumed immediately. But transferring stocks, that leverages the whole learning by doing mechanism. It forces households into the market, kicks off that learning process, permanently reduces their mental friction, and ultimately creates lasting wealth, resilience, and way higher consumption when they hit retirement. It's a total game changer.
So, distilling all this heavy data down, the big takeaway for your own life is actually pretty simple. Get into the market early, because the experience itself pays compounding dividends in both your knowledge and your long-term wealth. You don't need to be rich, and you definitely don't need to be an expert to make your first move. The research clearly shows that early life market participation gives you a much longer runway to just learn by doing. Sure, you should expect some market bumps and shocks along the way, but households that actually participate are fundamentally more resilient in the long run.
The barriers to entry have literally never been lower, yet the cost of just sitting on the sidelines in cash has never been more obvious. So, knowing that taking action is actually what creates your expertise, what is stopping you from making that first trade today? Thanks so much for joining me on this explainer. Keep learning, keep doing, and we'll see you next time.